Okay, we're good to go. So, welcome everybody. Welcome to the first ever IncomeShares Discord AMA session. Hopefully, we'll be making more of those in the future. My name is Simeon. I am the one who's been behind the account all this time. I gotta say, it's been an absolute pleasure having these discussions with you guys over the past few months. The way this is going to go today is first we're going to have a quick overview of the products themselves as an introduction. Then we'll move on to the questions that you guys provided over the last couple of weeks. And they'll be answered by John and Octai, two faces that you're probably already familiar with. And as soon as we're done with the questions that we have already, you'll be able to ask some new ones. So let's get it going. Octai, John, stage is yours.
All right, thanks a lot for the intro, Simeon. So yes, Simeon, as he mentioned, he's our community manager, and he's the one that's been aggregating a lot of the questions that you guys have been asking over the last few weeks, and we're very thankful for your feedback as usual. So for anyone that doesn't know myself, my name is Octai, and I've been with Leverage Shares, which is the mother company of IncomeShares, for going on 7 years now, and I head up global communications and strategy. And John is basically our lead research analyst that's working on all of the amazing content you guys are seeing. The IncomeShares. He recently put together a report that was picked up by the Financial Times, and he keeps basically all the content updated regarding performance figures, historical distributions, and anything else that you could think of. Okay, so John, you want to say a few words before we begin?
Yeah, thanks for the introduction, Octai. Yeah, pretty much was going to say the same sort of thing. I think by now you all know the products that we have. So just a quick overview. We have single stock ETPs, we have basket ETPs, we have ETPs that sell options on precious metals and fixed income. But we'll get into all that a bit later with the questions. Yeah,
so just before
probably ready to go.
Just before we begin, I just want to read like a quick disclosure. So all view statements and opinions are solely those of the authors and don't represent those of Leverage Shares or its affiliates, including IncomeShares. The Leverage Shares and its affiliates don't endorse, confirm, or accept any responsibility or liability for the accuracy, completeness, or consequences of any information provided. Okay, that's a mouthful, but now that we have the disclosures out of the way, John, sorry for cutting you off, but maybe I could just give a quick intro to IncomeShares before we begin, and then I think after that we can, I'll let you finish, and then we dive right into sort of the questions after that, if that's okay. So yeah, for anyone not yet familiar with IncomeShares, we're Europe's widest options income ETP platform. It was launched back in 2024, obviously as part of Leverage Shares, which is a firm that's been building single stock ETPs in Europe since all the way back in 2017. The underlying idea, I think, is very straightforward. We hold an asset, which could be an individual stock, it could be an index, it could be a commodity, and we sell options on it. And in return, we collect premiums, which are then ultimately paid out as monthly distribution. The platform has grown quite a lot. We are closing in on 55 products, and hopefully by end of the year, we will have at least another 10 to 15 with you guys. Not to mention that in a very short period, there will be a few more that will be listed. So keep an eye out for those. Yeah, with that, I think, John, we can begin.
Yeah, I think we should go to the questions. Simeon, if you go through those, we can start answering them.
Sure thing, guys. Okay, so going to the questions that were asked in the Discord server. So the first one is,
he's not there, so I'll just read out the first question.
No, sorry, I just had myself on mute, sorry. So moving on to the questions that we got in the Discord server. So the first one is, with the recent drop in indicative distributions across some products, can IncomeShares explain the main drivers behind the change? Was it mainly lower implied volatility, lower option premiums, underlying price movement, strike selection, hedging, premium being retained inside NAV, or a combination of these? This one goes to John.
Thanks. It's a good question. I mean, I guess I'll first answer it at a high level, and then I'll drill down into actual yields for June and yields in May and how those differed. So at a high level, the majority of the time, it almost fully is explained by the implied volatility. The distribution comes from other factors. So you've also got strike selection. The strike, if it's closer to the price, you can collect more premium than those that are further away. You've also got the underlying price move. So if these change, the equity value can also change. It changes whether the options are exercised. The implied volatility is the big one, though. Obviously, if the markets are calmer, it means you get lower option premiums for selling options. So that income, which is where it comes from, goes down. Now, June itself, if you look at June and you compare it to May, so we can just talk about this month's yields since they're now in, it was a bit of a split. They didn't all go down. It was about 54 products, 32 yields went down, 19 rose, and 3 were flat. So it wasn't all one way, and most of that was down to just the volatility of the market and where volatility went. The single stocks, they compressed in volatility, so we did have a bit more lower premiums for those. But then with the indexes, actually there was more volatility or implied volatility. Those moved in opposite directions, so we did end up getting more premiums for those. So I'm going to share my screen because I've actually got these all over here, and let me just see if I can share this one. Okay, so you can see over here we've got this sheet shows the yields in June, and where it's red it means it went down versus May, and then on the right of that you've got the average. This goes back 12 months, so it shows all of the yields over the past 12 months. Obviously some of the products we've only recently launched, like Oracle for example and Robinhood, so we only have a couple of months of yield over here. So if you look at I think we'll start with the digital assets, so the crypto. This one had the biggest drop across the board in terms of yields, and this was down to implied volatility being lower for crypto. Although it looked like the crypto market itself took a big drop in June, the actual volatility, implied volatility, did go down, and that's reflected a lot in the actual yields. And if you look at something like iron, for example, that was 145 this month, which is obviously still a very big yield, but that's dropped a lot because last month it was 240%. And remember, iron had the earnings last month or in May, so it was very high in May, and actually it was more in line with its average in June. We can also look at a few others. So if we go to the Magnificent Seven, the bigger names, these generally went lower, and that was also down to the implied volatility. Google was basically flat, and then Microsoft, you had a slight uptick in that. The singles, the baskets. So just going to get down to that. The diversified ones, this is where the yields were a bit higher. So if you look at the NASDAQ, that went up from 47 to 67, and then the S&P went up from 26 to 39, and then some of the baskets also had higher or increases in yields too. So that's the general picture of how the yields went. But also remember, these are annualized yields, so they are if a 2% yield happens in 1 month, that's effectively, it looks like 24%, so it can look like a large change. The best thing to look at is this average column over here, where you can see over time that the averages show a better picture over time, because the volatility is always going to change of the underlying stocks, and those I do put out every month in the monthly investor update. So I hope that answers your question.
So yeah, that's a really good point, John. I mean, once again, for especially the single name products, we're not targeting any amount of yield, right? We have a target in terms of what kind of delta we want to target on a weekly basis. And obviously that's going to change in terms of how much premium is collected, in terms of what the options market is pricing. And whatever we collect in terms of the extrinsic, we pay out the full amount. So if there's a decline month over month, there's a big chance, or it's almost definitely explained because of a drop in implied vol, and vice versa. When you see a big pop, usually that coincides with increased volatility in the market. And one of the things to remember is that there's almost like an inverse correlation. When the stock drops, volatility tends to go up and premiums tend to go up. And when stocks tend to rise slowly over time, volatility actually drops. So you might see an increase in the price, but that's probably going to coincide with smaller distributions just because the volatility is falling on the asset. Just wanted to add that. Okay. Should we move forward?
Yeah, sure. Let's move to the second question. This one is going to be for Oktay. So, when investors see a large month-on-month drop in the indicative payout, how should they interpret it? Is it simply a lower income month, or could it sometimes indicate a more NAV protective approach?
Okay. Yeah, I think I almost answered this one. But like I said, a large drop usually, I want to say almost entirely, but of course there are some factors that might take place, but it's almost entirely because of what happened with implied vol. So it coincides with lower volatility, which means smaller option premiums that can be harvested. And options income is going to vary month to month, and that's by design. So a swing is not necessarily a signal of a problem on its own. So that's why you have to always look past the headline number, because that number alone is never going to tell you the exact cause. Sometimes the percent yield can drop because the NAV has increased, and that yield is always a percentage of the month-end NAV. So yeah, and just to provide an update on sort of the strategies that we've alluded to in the past, because I know a lot of people want to know about those. So we haven't yet implemented any particular changes yet. We talked about things that might further protect NAV and, some other changes that might be made. We are currently speaking with the market counterparties on when we can start implementing those. But before any action is taken, it's going to be communicated to the market. So I just want to let everyone know that it will be publicly announced before they take place. So I just want to make that clear.
Yeah, so naturally, as these questions have been given by different people, sometimes they kind of overlap. The third question, it's kind of similar to the past two. Has anything changed in the strategy recently regarding NAV protection, hedging, strike selection, or how much premium is paid out versus retained inside the fund? I think you kind of covered that already.
Yeah, I did. I mean, I don't know if John wants to add any additional color.
Yeah, I mean, it's the prospectus does allow us to do the hedging, but it's something we'd have to test a lot if we wanted to implement it. So if we do it, we would communicate it as Oktay said. Yeah, and also there's no free lunch. I mean, if you're going to hedge, that might have other effects. So it's not, you've got to test it through basically before you actually implement anything like that.
Yeah, and just in general with options, usually the more profitable ones or the side of the options trade that's more profitable over time is the side that sells, just because a lot of options tend to expire out of the money. So anytime you want to buy additional positions, let's say it's to hedge or whatever it is, you're essentially making a discretionary call. You're saying, okay, I'm going to spend additional money to buy some downside protection. But in many cases, you buy it and that ends up being an expense for the fund, and that's going to have an effect on the overall total return. Just keep in mind that hedging, of course, it's something that we can implement, but it will have a drag on distribution for one, and probably of the performance of the overall product itself, just because it's an additional expense that has to be factored into the fund itself. So like John said, there is no free lunch. Again, there are various different things that we still want to implement. So we want to make some tweaks to sort of like the coverage ratio. Right now we have, at least with the single names, we have 25% that's fully uncapped, meaning it's invested into the equity. So that portion might be increased. We also want to, we're still discussing this, so I don't want to imply anything, but there are some other things that we want to discuss regarding the strike prices and the types of options that are implemented. But again, it's going to be communicated beforehand, and everyone will have a clear idea of how it will work before anything is done.
Thanks, guys. Moving on to the fourth question. Maybe Oktay can answer this one. Can the monthly distribution commentary give a clearer breakdown of what affected each product's payouts, such as implied volatility, premiums collected, underlying movement, NAV impact, and retained premium?
Yes, to an extent. So, just to maybe take a step back and give an overview of like how the strategies are basically broken down within the funds. So we run covered calls on 3 products currently. So that's the gold product, the silver product, and the fixed income, the treasury product. And since around these, I believe it was December, these are essentially targeting 1% a month. So anything that's earned above that stays inside the fund. And basically that's to support some level of consistency. Now, with the single stock put rights today, the full extrinsic premium that's earned throughout the month is paid out. So historically, when there were months where some products were annualizing well above, let's say, 120, 150%, we did make a discretionary decision to retain a portion. I believe this was done twice. So it was our mistake that we didn't communicate it beforehand, but that's not money leaving the fund, right? So whenever you have a distribution, it's essentially you have the NAV and then you have the distribution. So if it's not paid out to you, it's still remaining in the NAV itself. So it's not like the money is withheld with the asset manager or something like that. It either stays in the fund or it gets paid out as distributions to the end client. So for now, we're not going to be holding back any part of the overall extrinsic premiums that are harvested until we make a definitive decision on whether there will be a limit. So let's say we might have a limit on the upside cap, right? Let's say we might cap it at 100% max, whatever. Hasn't been sort of decided at all. But even if that were the case, obviously the portion that's not paid out remains in the fund. So there is a level of discretion to it, but once again, once the decision is made, it's going to be communicated obviously beforehand to all investors.
Thanks, Oktay. Maybe the next one can go to John. I think we did answer this one in the Discord, but let's answer it here as well. Can you clarify how the website distribution yield is calculated and how it differs from an investor's personal yield on cost? A lot of investors may see the headline yield and assume it's their actual personal return.
Yeah, so that distribution yield you see on the website, that's going to be a fixed, it's based on the last distribution payment, and that's taken by dividing it by the current NAV. So every single day, the NAV will change, but the distribution will be the last distribution. So that's why you see a change a lot day to day, because you're dividing it by that NAV. In terms of the yield on cost, that's obviously something more personal, and that just measures the distributions that you actually get and you receive based on what you've paid. So, a personal yield that can obviously be higher or lower than the actual yield, but that's not something we would have access to because these are exchange traded products and they trade on an exchange. We don't actually collect any of that information, so we wouldn't have it. They would be traded through your broker, not directly through us. Yeah, I think that probably explains it. Maybe I could give an example if that helps. I guess if you look at, let's say you've got a 50 cents payout and you've got a $6 that's $6 annualized, and that shows 100% at $6 NAV. If the NAV were to drop to $5, then it would be 120%. So that's just how it works. So that just updates depending on the NAV. And then at the end of the month, when the new NAVs are published, those go on the website, and then you will see that calculation happen again. And that's why you can often get a big change on the day that the new NAVs go onto the website.
Yeah, exactly. I mean, it's a very basic formula. We just take the latest distribution amount number is the nominal amount. So if it's, let's say, 10 cents, you annualize it, and then you divide it by the most recent NAV. So that payment that's actually paid, obviously that only changes once a month. So that's constant for like the entire 30-day period. The annualized number, the multiplication by 12, that's also constant. The only thing that changes day to day is the updated NAV. So whether the NAV is lower or higher the next day, that's what's affecting sort of the headline distribution that you see on the product page. So it's just a matter of industry standard calculation and how it's displayed. But yeah, that's why you see those daily changes. And I know it's a little bit confusing. I don't know if we have the exact formula on the website, but it basically works the same for all sort of options income products and how they display itself. Maybe we need to do a better job of disclosing how the numbers calculated.
Yeah, guys, thank you for answering this. Like I said, we already did provide an answer for this question on the Discord. I think maybe it will be a good idea for me to highlight this after the call. So the answer that we have on the Discord has the example and the formula and everything. So yeah, this is something I will do after the call. I'll highlight it so everyone can see it. Moving on to the next question. What is the best way for investors to judge whether an IncomeShares product is performing well over time? Headline yield, yield on cost, NAV stability, total return including distributions, or all of these together?
I mean, I could probably jump in on that one. I mean, total return is ultimately the thing that you want to look at, because that's going to include your NAV, how that's moved, and then also the income that you've generated. The headline yield, that's important because obviously it just measures the yield that you've got, but obviously a high yield, as Oktay's just mentioned in the last question, that can mask a falling NAV. So total return is obviously very important. NAV stability, that's something that's worth watching. You just want to make sure that there's not too much NAV erosion. The yield on cost, as we've covered previously, that's a really good thing for investors to track themselves. But again, it's personal and it's not a measure of the product, because they could have got in at a better time. Obviously, there's always going to be a trade-off between yield and the upside capture. So total return is the fairest gauge. And a bit later on, I'll actually go through some of the total return slides so I can explain that in a bit more detail.
Slight mistake on my part, guys. I skipped one question. Going back to number 6. When looking at the indicative distribution graph, what should investors understand about the numbers shown? Is it a forecast based on accrued premiums and cash interest? And how much can it change before the final declared distribution?
Okay, I'll take this one. So this functionality on the website is actually something we implemented because of feedback from the community. And one of the things that we've been getting asked over and over is whether we can switch to weekly distributions, which is something I would love to see someday. The European, let's say, piping of just dividend payments is simply not there yet to make it feasible. So because these are paid out monthly, people have no, I would say, direct transparency to see what to expect at the end of the month. So the whole decision behind it was to come up with some kind of forecast that gives you some kind of idea of maybe what to expect at the end of the month. But of course, this figure is only an estimate. It's very indicative, right? Because it reflects the amount of premiums that were harvested month to date. But the thing is, you have, let's say, 4, maybe 5 weeks or 5 rolls within a monthly period. And what might happen is, and this happens often, the first week might be very volatile, so you collect very high premiums. The next week, it falls off a cliff. So the forecast tends to drift a little bit. So we noticed that when we put a forecast figure that's updated weekly, and there's still pretty, I would say, relatively drastic changes week over week, we're getting a lot more questions on why the forecast is changing so much, and then the monthly payments, why is it ending up very different compared to the forecasted amount? So the entire reasoning behind this forecast is basically to provide more transparency. But I kind of get the feeling that it's leading to more confusion than actually helping people. So right now, what we're doing is we're gonna continue that functionality, because I think a lot of people sort of find value in it. But it's going to be updated after the second week or the second roll through the month. So you will have a forecast figure about 2 weeks in terms of what to expect for the rest of the month. So what happens is we'll take the 2-week period and we basically use that to extrapolate what to expect at the end of the month. But again, it's some indicative number. It's an estimate. It should be somewhat close to the end result, but if there is, a difference because, vol falls off a cliff or something else, unfortunately, that's just out of our hands.
Thanks, Oktay. This next one is going to go to John because I believe he has some data for it. Pick 3 or 4 single stocks you cover via ETPs and compare the 2 scenarios. Invested directly in the stock or invested via your ETP. Choose start date, the time since you've changed the strategy by trying to protect the NAV. In this way, investors may see whether they benefit investing in the ETP or directly in the stock.
Share my screen. Okay, so I picked 3 different stocks here because I think each of them has a bit of a different story to it, and it gives you a range of the different products and how they've actually performed versus the underlying. So I'm going to start with Amazon. We've had this running for a very long time. If you look over here, it's started on the 26th of September, 2024. And then I just wanted to check, can you still see the screen, Oktay? Because I'm getting a message here. You can see it.
No,
okay,
I can
good.
see it, yeah.
So you can see it, okay. So it started on the 26th of September, carried on till the 30th of June. So that's as of the end of June. And this is a cash secured put on Amazon stock. So it holds Amazon stock 25%, and then it'll sell put options with the remaining exposure. 3 lines over here. You've got the orange line, which is our ETP, AMZ, plus the income reinvested into the fund. So that is the total return I was talking about earlier. And then you've got underneath it Amazon stock itself, the black line. And then you've got AMZ price only. So this is just the blue line where there's no income. That is just the NAV itself with no income reinvested or no income included. So over the period, just under 2 years, it has outperformed on a total return basis, 30.3% versus about 25% for Amazon. But the important thing is that you don't always look at the return. You also want to look at the volatility. The volatility was slightly lower, so some of that options income, I guess, helped reduce some of the risk. And then the maximum drawdown, which is the worst case loss from top to bottom. So if you bought in at the worst possible time over that period and then sold at the worst possible time of the period, that would be your max drawdown. And that was minus 26% for the AMZ, so options ETP, and then it was worse off with Amazon at minus 30. Just to highlight the yield on that, with a $10,000 example, over 12 months, it would have yielded $3,500. But obviously, that makes up a lot of the total return, because if you don't include the yield, you have a lower return than the stock. The next one is, and I think a lot of people will be interested in this one, is obviously MicroStrategy. It's had a horrible downtrend since we launched our options ETP on 27th of June. The stock itself has gone down a lot. It's gone down 37.35% as of the end of June. Our options ETP, it's actually slightly above that with a total return basis, but it is still down. Because these products themselves are not hedges, but they do just aim to pay income and offer a different sort of return profile. But then if you look at the daily volatility, it was lower than the MicroStrategy underlying stock if you include the income reinvested. So it's a slightly different return profile, but it does track, not exactly, but it does move with the underlying investment a lot of the time. The yield on that was obviously much higher for something like MicroStrategy because you're selling put options on a very volatile stock, and that was 8,500 over that period. But obviously, without the income, it is worse off than the stock. Yeah. Tesla is another one. I think this gives you a more. This is an example where the stock itself has beaten the total return of holding the options ETP and reinvesting the income. So 56% over 2 years effectively versus Tesla's 70%. But the interesting thing here is that if you look at the maximum drawdown, it's not as bad. So the worst an investor would have been down over that period would have been 40%, whereas with holding Tesla would have been 53%. So it's a slightly different return profile, but it's always good to gauge the total return, and reinvesting the income would give you, I guess, the easiest way to compare the actual performance between the two. So I hope that answers the question.
Yeah, and maybe just to highlight again, a lot of people, when they look on their brokerage accounts or maybe on the free data sources, the performance figure that you see is the price return. So it would be sort of that blue line that you see on this chart. So that only tells you half the story. You have to add back in what the premiums that have been paid out are to get to the total return figure. That's the more apples to apples comparison if you want to compare to the underlying stock. Of course, I mean, the objectives of these products are primarily income and then secondary growth. So income is, of course, the main sort of key selling point of these products. But once again, we do want these products to evolve so that they can capture an even higher portion of sort of the big upside moves that you can expect from a lot of the growth names. And also, we'd like to get your feedback on, what you want to see, right? You guys are very active in terms of telling us what you like, what you dislike, etc. And we take all of those into account. So whenever we get feedback on what kind of new products you want to see, that's amazing information for us, right? It makes our job a lot easier, honestly. Because we've seen, or me personally, I've gotten a lot of messages about, very high payouts and, especially on the more volatile names like maybe Coinbase and MicroStrategy. But if I look at the figures, for example, in terms of inflows into products year to date, some of the ones that have taken in the most money are exactly those names. So Coinbase is among the top, Tesla is among the top, and MicroStrategy is among the top. So that tells us that there is still an audience out there that wants very high distributions, and they want to be the ultimate decision maker in terms of, do they want to reinvest that back into the product, or do they want to sort of, use it to finance their lifestyle, pay bills, etc. So keep giving us your feedback.
Thank you, guys. Moving on to the next one, maybe for Oktay this time. Are there any plans to show estimated retained premium or premium paid out versus premium retained on the product pages? Will IncomeShares consider publishing a simple monthly what changed and why note for each product, especially where indicatives have moved significantly month on month?
Mm-hmm. I think the best way to probably go about it would be to do a more regular, maybe a session like this, or maybe on another platform where we can sort of go over the figures. Because the one thing that we're a little bit more careful about is publishing raw figures without context, because let's say we put a retained premium number on its own without the Y. I have a feeling that this is going to tend to create a lot more confusion than clarity. So for me, the realistic path is to maybe automate it, like paid out versus retained at some point. If we get to that place in terms of changing the strategy, right? Because right now with the single names, we're not retaining any of it. The full extrinsic that's harvested is paid out. So if you see a decrease in NAV, that's a function of what the underlying stock has done. Regardless of whether the stock went up, down, or sideways, we're still going to pay out that income. And it's basically transferring money from one pocket to the other, right? But yeah, I mean, I'm open to putting more items on the website. Once again, give us more of that feedback. But I do want to be a little bit more careful that it doesn't end up confusing more people than it helps.
Thank you, Oktay. So the next question is a four-part question, and it's mostly in regard to high volatility single stock ETPs, and namely Coinbase, for example. So the first part of this question is, if the underlying asset's price experiences a prolonged and steep decline, how does the ETP's option strategy adapt to mitigate severe NAV erosion?
Do you want to take it, John, or should I?
Yeah, I could go ahead and so. I mean, as I went over with the MicroStrategy slide, that was a good example of this, where the underlying asset went down a lot. So the income can help cushion part of that stock decline, but it doesn't prevent the NAV from falling when there's a sustained stock market drop, because the ETP sells in the money puts. It does hold the equity. So yes, the premium can help cushion it, but it doesn't actually, it's not a hedge, right? Yeah, I mean, that's basically it. I mean, it can't fully offset a large sustained capital loss. If you don't like the stock itself, I think then it's probably not good to hold the options ETP, is a way to think of it.
Yeah, I would echo exactly that. I'm a fan of what Coinbase is doing. You don't like the stock? the options income product, whether it's from us or from another provider, I highly doubt you're going to be fond of its performance if the underlying stock isn't doing well either. So unfortunately, you get that same, let's say, single stock or esoteric, whatever risk that's linked to the individual company. So whenever you invest even in a single stock options income product, obviously there's going to be a very slight cushion, but if the underlying is getting hammered, don't expect like massive outperformance from the income product.
Okay, moving on to the second part of this question. Not sure how much detail you guys can give about it, but at what point do the collective premiums become insufficient to offset the capital loss of the underlying?
I mean, once the price fall, if the price fall is bigger than the premium collected, that stops it from being offsetted. So if you're collecting a premium and the price fall is bigger, it's going to go down, basically. If that makes sense.
And yeah, I just want to add that we pay monthly income whether the underlying is going up or it's going down, because the income comes from the premiums. It's not coming from the gains, right? We're not financing the distributions from whatever the stock did. So if the stock went up, that doesn't mean we're going to pay out a higher distribution because of that. Whatever we collect in terms of the extrinsic premiums, that's ultimately what's paid out. So, in a scenario where we didn't pay out because let's say that the stock were to go down in order to protect the NAV or something like that, that's exactly what income investors don't want, right? People are interested in these products because of the regular monthly income. So if all of a sudden, if the stock starts going down for a prolonged period, 6 months, 1 year, maybe more, and if a company stops paying out the income from it, then essentially you're transferring it into like a growth stock because you're not getting the income. So this is what differentiates these products from dividend stocks, from traditional fixed income, from REITs, rental income, whatever. It's a diversified source of income.
Okay, I think I'm going to combine the last two parts of this question. So it goes, in a worst case scenario where the NAV drops significantly, is a reverse stock split part of the structural game plan to restore the nominal share price? And if a reverse split is executed, how many times theoretically can or will IncomeShares perform this corporate action for a single ETP before considering the product unviable?
I could take that. Or, I mean, look, a reverse stock split is something we can do in theory. It's not something we currently have planned for anything at the moment. But in theory, you could do as many as you allowed, but it doesn't change the value of the underlying position. And I think that's the important thing to kind of clarify. All you're doing is, you're basically increasing the number of shares, and you're reducing the value of each of those shares so that the overall value is the same.
Yeah. Or in the case of a reverse split, it would be opposite. So like the price would be higher, and the amount of shares would be lower. But I just really want to highlight that a reverse split is an ETF industry standard, and it doesn't change the economic position of any individual investor or the fund in question. Like any ETF, a reverse split has no impact on total income or the value that you're receiving. So the per share numbers, they're essentially just rescaling. The AUM remains the same, etc. The entire idea behind the reverse stock split is to bring the price of the number of the NAV to a more operationally stable ETP. Because just remember that whenever you see a price on your brokerage platform, like let's say if it's 543, that number is a quote that you're seeing from a market maker. So obviously we work with institutional market makers that are pricing these products intraday, so that's coming from them. And for them to be able to quote them properly, they do need a decent number, right? So imagine if the price was, let's say, 1 cent. You can't have a bid that's, you can't have an ask that's 1 cent and a bid that's 0.00. It's just operationally not possible. You can go to like multiples after the decimal, but it's just like some brokers don't even show multiple digits past the decimal. So that's why if you just bringing the price up, whether it's from 1 to 10 or from 10 to 100, it doesn't economically change the AUM. It doesn't economically change what you're getting in terms of performance. income, etc. It's just purely operational. And to give you an example, especially with like the world of leveraged and inverse ETFs, this happens all the time because people hold them for very short periods. And just because the price has gone down doesn't mean the product is not viable to be run anymore or that investors have lost interest in it. It's just a function of how the underlying has performed. So what you'll see on a brokerage platform, usually once a reverse split takes place, is just prices adjusted. So the initial price won't go from, let's say, $10 to $1. The initial price will be updated on the brokerage platform as well to say that it started at $100 and now it's down to $10. So everything is adjusted to make sure that operationally everything can continue to run smoothly. But once again, a reverse split doesn't mean that the fund is in danger. It doesn't mean that the firm is in danger. Nothing like that. It is an absolute industry standard.
Thank you for that one as well. Okay, so the next one has pretty much been covered already, but as we promised that we're not going to skip any questions and there will be no filter, I'm going to go ahead and read it. How much profit are leverage shares retaining and whilst using investors' money in doing the options and now return to shareholders in much less? Of course, leverage shares are making money. Can we see some transparency, please? After all, we are the shareholders. It may sound controversial to some, but questions need to be asked.
John, maybe I can sort of address this one first. When you're launching a regulated product that trades on a regulated exchange, and obviously there's a lot of regulatory requirements behind it, and you're working with a lot of institutional counterparties, so you have custodians, you have market makers, you have exchanges, a lot of industry counterparts. So there's a lot of checks and balances with any ETF/ETP that would not allow this. So let me just walk you through why it can't work, right? So we don't hold your assets. That's an independent custodian. That's what they do. So the fund, when it sells options, the premium lands as cash in that custody account, and the independent administrator reconciles. I mean, I don't want to get into all the details, but essentially, it's there's an independent trustee that overlooks all of the assets that are not obviously directly handled with leverage shares. So our revenue is the published amount that you see, which is anywhere from, let's say, I think 35 to 55 basis points. So if we were to retain, let's say, a premium in any given month, that stays inside the NAV. So you still own it, or whoever is a shareholder owns it. So nothing has actually left the fund. And on top of that structure, there's like a market check as well. So market makers, they price these products off of the underlying plus the options positions. So if the NAV were to persistently, let's say, leak, or I don't know, they see something that they don't expect from the strategy, they would flag it, and obviously they wouldn't be able to price it properly. So that would mean that you wouldn't see active trading on these products, and no market maker would want to work with an ETF issuer like that. So there's a lot of like checks and balances within the system to not allow anything like that. So just like with any other ETF ETP issuer, our money is from the management fees that we collect, and we have over 250 products in total in leverage shares. IncomeShares is about 50 of those 250, and we're not planning on closing down or winding down any of the products. Actually, over the next, I don't want to give a certain period, but over the next, let's say, close time frame, you're going to see new products come to market, and this is a business that we think might ultimately be bigger than sort of the leverage ETF business that has been our bread and butter for a longer period.
Okay, let's give the next one to John. Hi, I think that you should be as transparent as some US peers are regarding option ETPs. You should say every month how much of your distribution is coming from option premiums and how much from NAV decay in order for us to check if long-term is healthy to invest in your products. Because the problem or technicality of option ETFs and ETPs is the NAV decay in the long term.
Yeah, so the distributions, they come from the option premiums we collect. That's real income. It's not your own capital being handed back to you. Like any fund that distributes, the NAV can fall by that payout amount when we pay it, and that's just normal distribution mechanics. It's not it's not a return of capital. It would only be a return of capital if we actually paid out more than the strategy earned in that period. The NAV can simply fall when the underlying has fallen. So that's just the market moving, not the distributions. Again, I think it's good to look at total return here. That's the main thing, because that can show you what's actually happened. It's not necessarily the falling price. I mean, if you look at an example, you could say, well, a stock that pays 100 all year, while we pay out roughly 1% a month. If the price then walks down to 100, 91, 84, 76, but your total return still stays flat, that's because you've received the difference as cash. So yeah, I hope that works.
Maybe just to give like a very simplified example as well. Let's take a stock that's at $100 right now, and that stock doesn't move at all, right? It's at $100 for the entire year. Every month we're selling, multiple times, we're rolling weekly options, whatever. Let's say each month we're to collect $1 worth of premium. Well, the NAV throughout the month would drift up to 101 because the stock is still at 100. We collected $1 premium, we're at 101. And then at the end of the month, we distribute $1. So the NAV is going to step back down to 100 because $1 has been paid out in distribution. So the total return is, that 1%. So when you repeat that 12 times over the course of the year, at the end of the year, the NAV is still going to be $100, but investors have also received $12 in premiums. So the NAV didn't decay and the stock price didn't move, right? So we can't pay you something based off of the stock price's move. So you received $12, and that was fully because of the options premiums that were harvested throughout the year. So once again, we're only paying out whatever is generated through options premium that's collected.
Thank you, guys. Moving on to the next one, maybe for Oktay. Across the IncomeShares website, can you please clarify whether all displayed figures are accurate as of the update dates shown beside them? I have noticed that the headline distribution yield percentages appear to change regularly. Yeah, we did actually cover this across multiple products, but the as of date often remains fixed on an earlier date, such as the 29th of May 2026. I have also noticed something similar with the indicative per share figures. Some pages show the indicative per share amount as updated on the current date, but the actual number appears to be the same figure that was showing around the previous declaration period in mid-June. Can you confirm whether these figures are genuinely recalculated as of the date shown, or whether there is a website timestamp caching or display discrepancy? This is important because investors need to know whether the distribution yield, distribution pool, indicative per share amount, NAV, holdings, and shares outstanding are all current.
Okay, wow,
it's a long
that's
one.
A lot to unpack. I mean, at all times, I don't check the website directly at all times, so everything is automated. I would say 99.9%. So all of that has a source, all the data that we're displaying. So if there are some bugs from time to time, I mean, if we miss it, please just drop us an email so we can correct it. But for the most part, everything is very much automated. So those kind of discrepancies shouldn't happen. In the indicative per share figure, once again, I mean, that's a forecast. So we will show it once a month in the middle of the month, and then obviously at the end of the month you have the actual declared amount. But I don't want people to take that at face value as this is going to be the set in stone amount that I'll receive end of the month. It's there to give some kind of indication. So I don't necessarily want to create confusion where people really use those figures to make some kind of forecast about what to expect. I mean, with the shares outstanding and things like that, those should all be correct as of when you look at the NAV. It shows the date as of which the NAV is updated. So for example, today is Friday. The NAV that you see on the website will be the NAV as of July 2nd, and everything else should be the latest figures as of July 2nd, because of course the trading day is not yet over today. So the NAV for today will be displayed on Monday. But yeah, I mean, if there's any discrepancies, reach out to us. We'll fix it.
Thank you, Oktay. So moving on very close to the end, last three questions. Maybe John can answer this one. If the amount of money managed by the various ETPs increases, will the fees or total expense ratio go down?
No, it will not. So that's just a set fee. It's just basically, it's based on the amount of assets under management. So if the assets under management go up, the total expense ratio is just going to stay at between 35 basis points and 55 basis points of that assets under management. Any decision to change fee, that would be a company decision, and we would obviously advise of that if we did. But it's not an automatic mechanism that does that. Yeah.
Yes. So yeah, the TER, the management fee, this once again, it's the same with all ETFs. It's a percentage of whatever amount is invested into the product. So if you've invested, let's say, I don't know, $100, the management fee that would be, impacting, let's say, the return on your investment would be, what is that, 35 cents, I guess. And then as you scale up, it's a fixed percentage, basically. So whatever amount you invested, the amount is reflected in the NAV, and it's calculated or it's factored in daily. So just to give you an example, let's take a very, very rough example, right? So let's say if you invested $10,000 into an ETF that charges 1%, and throughout the entire year, the price of the instrument that you invested in didn't move at all. So your $10,000 should not have, gained or lost based on moves. At the end of the year, you will have 1% less invested. So that 10,000 will have, 1% less, just because that management fee is being taken out every single day. So it's like an annualized figure, but every single day you just divide it by 365 if you want to see how much is being impacted by the management fee on a daily basis. That's how it works for all ETFs.
Okay, we have another question regarding how yields are calculated on the website. I think we're just going to skip this one because it's been covered multiple times already. And then the last one is, what measures are you to implement helping ETPs recover after X date massive drops? Why do they never recover after X date? Thus, we are having each month constant dips.
Yeah, I'll take a crack at this one. It's one of the, I guess, most talked about topics when you're talking about income options product. It's your upside is capped, your downside is, you only have a small cushion at best. The best way would be to sort of work out the math of this, right? So I'm sure you can just go on ChatGPT or whatever AI tool you use and just have it worked out, right? Because if the fund starts at $100 NAV, you're selling, let's say 1 month calls with a strike of 105, and you're collecting a premium of about $2. So at the end of the month, that $2 is going to be paid out. And if the call expires worthless, the fund's going to keep the $2. But then if the NAV were to fall to $90 the next month, the $2 premium cushion is going to, it's going to cushion the drop a little bit, but then you've paid out the cushion as well. So I'm sure there's a lot of visual examples that you can look at. It's obviously it's one of the sort of limitations of covered call products. Your upside is capped, right? So the best case scenario for these products is sort of an environment where the underlying doesn't fly off the shelves. It's sort of range bound. And in those scenarios, these kind of products tend to outperform, and you probably won't see those instances of NAV erosion. But if the underlying is dropping and it remains very volatile, then you just have a very high yield with a NAV that's continuing to go down because the underlying is dropping. Once again, I mean, there's probably a lot of things that can be done to mitigate sort of how fast the NAV would fall, but that would almost be like being able to predict the future. Like if someone's able to tell me Tesla's going to go up consistently 5% every single month for the next 2 years, we can tell you exactly what the sustainable payout ratio would be given what Tesla stock is going to do and what's going to happen with its volatility. And it goes back to the previous questions, like if we pay out a higher number when the stock does one thing and pay out a smaller number when it does another thing, it creates, once again, even more confusion and a lot more discretionary decision making from the fund manager. So that's why I think many fund managers are going down the route of either following a specific index or they want to do something very systematic, because every active decision that you add on top, you're essentially making a directional bet on what you think is going to happen in the market. So every action is an expense. There are items, like I said, that we want to implement into the strategy that we think will help them participate more in the upside over time, because I think one of the most dangerous scenarios is when, not dangerous, but sort of the most disappointing scenarios is when the underlying drops and then the underlying rebounds quite quickly, and it might even get back to par. But then with a covered call or put rights or whatever the strategy is, you're capturing the full downside, but on the pop upwards, you're not rebounding back to par, and that's where the biggest issue remains. There are multiple things and strategies that can be implemented to basically help the NAV recover a little bit better than it would by just being fully capped. But once again, we're working on ways to fix the strategies or improve them even more. And like I said, there is no perfect strategy that works in all market environments.
Thanks a lot for covering this, Oktay. This pretty much sums up all the questions that we have from the Discord. I think we did a pretty decent job in covering all of them. We haven't skipped any questions. We haven't filtered any of them. As you can see, they are exactly how they were written in the Discord. So a big thank you to Oktay and John for taking the time to answer all of them. And we're closing in on an hour, so perhaps maybe if there's any remaining questions, feel free to type them up in the chat box. If not,
I just want to tell everyone, so this is a format that we're trying out for the first time, right? Especially on Discord. So if you guys would like us to do this more regularly, let us know. And any additional questions you have, I don't know if you can ask during the session itself or you should ask beforehand, but we'd be happy to try and answer them.
Yeah, great point, Oktay. This is obviously the first time we're doing this. We can always take some feedback. We know it could have been better probably, and we're always open to hearing your guys' preferences for the future. So we'll stay online on Discord. We'll close the call, but as you know, we're online 24/7. So whenever you have something to add, something to ask, we're always there.
I think we have some. Oh, we have some comments. Okay. Oh, we do. Okay, sorry. I just discovered the section now. I think it would be great if IncomeShares website had a notification indicating which products have NAV and which don't. And all the products have NAV, or do you mean NAV decay? Okay. When cash flow mindset, when exercise, what do you do? Buy, roll. So let me try to maybe answer that question, how the options trading actually works without maybe going into too much detail, right? So we have most of the, let's take a single name like with NVIDIA. So 25% is invested directly into NVIDIA stock, and then the other 75% of the portfolio is used to create a position on options. So we sell in the money puts targeting a certain delta, which depending on the volatility is going to allow more or less upside capture depending on where those strikes place. And let's say we were to sell the options on a Friday. Then with the in the money puts, the thing is, as the price increases, the price of the put sort of declines. So if we sold the put and then all of a sudden it became about 70, 80, 90% cheaper, we would buy it back that same day, and at the close of, let's say, expire that same Friday. And there are some details around which sort of next expiration period we would pick based on when the option was closed out. So let's say if it were to happen after Wednesday, then we would roll into a new position that expires the following Friday. Whereas if it happened earlier in the week, we would open up a new position that expires that same Friday. And another thing that we introduced, and this was announced across socials and regulatory announcements and things like that, was that we started to do rolls on Thursday, because especially when the stock price is very close to the strike price of the option sold, you have this gamma or pin risk that takes place. So overnight, for example, the stock might drop, and all of a sudden you're capturing the full upside. Whereas if you're able to close out the position a day earlier, you've already captured maybe 90 to 95% of the potential of that options position. So you're able to lock it in without taking on additional risk for the following day, because that's usually when you have the biggest moves, when you're very close to the strike price and the option is very close to its expiration date. Love the format. Maybe also an idea to talk about the future of IncomeShares. Yeah, absolutely. Excellent format. Question regarding 70-30 tool. If I reinvest 70% of the monthly back into the ETP to continuously increase my share count and use 30% for personal consumption, will the total return still reliably grow over the long term, regardless of? Okay, that's a question. That's a good question. I mean, I think it's a good disciplined strategy because it's very rules based. But whether the total return is going to grow over time, that's always going to be a function of the underlying. So let's take Coinbase. If Coinbase keeps crashing and you keep reinvesting a part back into the product, then the price is going down, the ETP is also going to go down. So once again, it's going to cushion the blow a bit, but there's no way for Coinbase to be down 70% and let's say the total return on our product to be, let's say, up 30%. I wish it worked that way. Maybe in a future where options trade around the clock and every single sort of let's say limit order you put in gets exercised, regardless of whether it's 2 a.m. or US markets are open. The products can always be improved, but right now there's still some limitations because normal stocks essentially trade around the clock. Options, there's no pre-market, there's no aftermarket. They only trade during normal sessions. So that's why you have massive gaps in, let's say, the option. The previous day closed at 6 and the next day opened at 1. You don't have that continuous flow where it goes from 6, 5, 4, 3, 2, 1. Yeah, in case anyone's curious. All right, anytime. Okay, guys, it was great. Thank you for joining. Hopefully, we get the audience. We pick those numbers up as the frequency grows. And thanks for your time.
Thanks, everyone.
Thank you, everybody.
Good weekend.